Good morning, everybody, and welcome to our briefing today. This is our fourth virtual briefing of the year. I hope you're all keeping well. I guess we didn't expect that we would be having so many virtual briefings, but we have been getting plenty attendees, so I'm delighted that you're all appreciating them. I guess it's harder to interact with you all in this environment, and we're keen to get as much feedback as possible. So we will be sending a survey to you tomorrow. So please complete that survey. It should only take a few minutes, and we will be offering some spot prizes for those who do as an incentive. So to kick off today, first up we have Conor Callaghan, who will be speaking to you about the Central Bank's consultation paper on recovery and resolution planning. That is still open and available for feedback until the end of October. Next up then we'll have Rick van Beers talking to you about a reinsurance paper that we recently published. He's pulling out some of the key conclusions from that paper and some of the more interesting messages. Finally, then we'll have Kevin Manning talking to you about unit matching and some experiences of clients in the UK from implementing this. At the end, we will have a Q&A session. Hopefully you have that functionality available to you in Teams. So please feel free to submit the questions and I can then publish them and coordinate a Q&A session at the end. So I will now hand you over to Conor Callaghan. Thank you very much.
Thanks, Aisling. I hope everyone enjoyed the fry-up sent by Deliveroo from the Conrad this morning. As people were saying, we had to adapt to the new normal. So I will be giving a walkthrough of the CBI's consultation paper on the recovery planning regulations and guidelines, or CP131 for short. I'll be using the slides for information on the CP, but also highlighting possible areas of consideration or challenges that the regulations might pose for companies. So I understand a number of you may already be familiar with recovery plans, with the CBI requiring a plan as part of all new insurance license applications, changes of ownership, and through general engagement with companies. And some companies are being proactive in setting up plans without any prompt. For those not familiar, I've included the IAIS definitions on this slide. So a recovery plan identifies options to restore financial strength and viability when the firm comes under severe stress, whilst resolution is when a firm is no longer viable or likely to be no longer viable and has no reasonable prospect of becoming so, and is generally regulator-led. These concepts of recovery and resolution were born out of the financial crisis, when some companies and banks were put under severe financial stress and ultimately went out of business in sometimes sudden and disorderly fashion, with knock-on impacts to the wider economy. The idea of recovery plans is to preempt any possible issues, monitor the risks, and have options in place that can be quickly applied, if required, to restore the company's financial position. So we'll start with a general overview of the consultation paper. It was published on the 25th of June and has a closing date of the 30th of October for responses. It details the draft regulations and guidelines for establishing and maintaining a company's recovery plan. It should be noted that the focus here is on recovery planning and not resolution. The CBI themselves have been preemptive in formulating them, considering recovery and resolution as part of the EIOPA Solvency II 2020 review, with EIOPA's view being that there's a need for a minimum harmonised recovery and resolution framework to be incorporated into Solvency II. I would say that the draft regulations are more a belt and braces approach than a minimum framework though. The regulations will apply to insurers, captives, and third country insurers with Irish branches within the scope of Solvency II and regulated by the CBI. Prism High and Medium High companies are required to submit their plans to the CBI, with the first plan due in 2021 and 1 month after board approval in following years. Other companies are only required to provide a copy of their plan to the CBI on request. And finally, the plan needs to be approved by the board and reviewed annually. Oh, apologies, I've clicked forward one. I think, Aisling, you might need to click back for me. Thank you. So the regulations provide the layout for the preemptive recovery plan. I've split the sections into 3 different areas that I want to cover off today, with me briefly discussing the areas in orange and blue, such as summary and preparatory measures, and going into a bit more detail on the section that really drive the formation of the recovery plan, such as governance, scenarios, indicators, and options. With the CBI giving the proposed format, some companies who already have plans in place or are looking to leverage a group format will need to consider how best to allow for this. We have found that it's easier to stick with the proposed format and leverage on existing templates where appropriate, rather than sticking with an existing format and trying to cross-reference to the CBI's new format. Also, coincidentally, this layout is how I want Stephen Kenny to line out Ireland in the Euro playoffs next month. I think we could really reap the benefit of a solid 3-5-2 formation with governance and scenario analysis bombing up the wings. So on to the opening sections of the plan. The summary is as you would expect it to be, but the CBI does call out that it wants the summary to highlight the overall recovery capacity of the insurer and when the insurer will consider closing its new business and how it will be handled. The CBI does flag that it wants information on closure to new business a number of times throughout the regulations. So it's important for companies to consider this point when looking into indicators, options, and scenarios. For the change since last plan section, these should cover changes under each of the sections. Just to note on preparatory measures, that this should flag any changes to the insurer or plan resulting from the implementation of previously identified preparatory measures or identification of any additional measures now required. So the governance section. This section is for documenting the governance arrangements, including the development and updating of the plan, as well as the implementation of the plan should a stress event occur. Within this section, the roles and functions of those responsible for the plan should be included, and this includes the roles and responsibilities of the board. The CBI are also looking for information on how the plan is integrated into the company's governance and risk management framework. So with this, it could be demonstrating the use of existing committees for escalation, a link between risk appetite KRIs and the recovery indicators, or a tie-in with the recovery scenarios and ORSA projections. A consideration for companies here is where the ownership of the plan ultimately lies. Does it lie with the risk function, as with the ORSA, or is it a cross-function ownership structure? The strategic analysis section is for providing a clear description of the insurer's business strategy, operating model, and organizational structure with a view to identifying likely vulnerabilities. So the regulations provide headings for the areas they want information shown, which I've outlined on this slide. The areas should be considered in terms of the nature, scale, and complexity of the insurer. The CBI has also provided guidelines for considering the different areas. So for considering key services, the policyholder's reasonable expectations should be taken into account when considering possible lapses. For critical functions, the company could rely on exercises already completed in this area for, say, business continuity plans. It's also important to comment on the outsourced operations and the interconnectedness of the insurer and its operations within the group setting if applicable. This analysis will enable all decision makers and the regulator to assess the implications of different recovery options for the insurer. So next up is the recovery indicator section. Recovery indicators are indicators that identify in a timely manner progression of risks that have the potential to threaten the insurer's financial viability. So the regulations stipulate that you must have indicators that monitor, at the very least, liquidity and solvency, but that further indicators referencing profitability, reserving, or market-based items should also be considered. For the indicators identified, there needs to be thresholds defined, which when reached result in monitoring, escalation, or recovery option implementation. So essentially a traffic light system attached to the recovery indicators. Where thresholds are reached, procedures need to be in place for notifying the regulator and the turnaround time for notification. So with this plan, it removes the possibility of a watch and wait or it will bounce back quickly approach that might be attached to the monitoring of existing KRIs. I've also listed some of the characteristics that the indicators should reflect and a number linked back to other sections within the plan. So for example, the indicators should be reflective of any vulnerabilities flagged in the strategic analysis section or show their integration into different frameworks, for example, if existing KRIs are being used. Finally, the recommendation is for the indicators to be reviewed annually and for the thresholds to be recalibrated as necessary. So the recovery options section will obviously be the driver of a recovery plan. And this section is to outline the options that could be taken to contribute to restoring the financial position following a stress event and or maintaining an insurer's ongoing viability. The CBI has specified a minimum of 4 specific options that would need to be considered. So firstly, actions to maintain ongoing viability or restore financial position. 2, actions to conserve or restore the own funds through recapitalization. 3, actions to ensure liquidity to meet the company's obligations. And 4, actions to reduce risk profile and SCR or restructuring of the company's operations. So within these, you could consider portfolio sales, capital injections from parents or markets, expense reduction programs, or reinsurance, for example. The regulations do state that captive insurers and third country insurers with Irish branches are not required to produce the above specific actions, but that the actions that are included should be relevant to the entity in question. The insurer must also assess the feasibility of the recovery options. So the key factors that might influence an option's feasibility are past experience in implementing similar measures, estimated timeframes for executing recovery options, and potential risks and impediments to timely and effective implementation of recovery measures. I think the final bullet point here on parental support is important to flag, as I'm sure many companies would look to their parent in time of need for capital injection, and it will form a recovery option for most. The CBI has specified that parental confirmation is required, saying that they will provide the injection when needed. The option also needs to consider the possibility of the capital injection not being available when needed. So these confirmations might be harder for some companies to secure than others, and might then impact on the recovery option feasibility. So I've talked through the recovery indicators and the options, and with the scenario analysis section, you're required to test the effectiveness of both of these. So once again, the CBI has specified a minimum of 5 specific scenarios. So the first scenario is a system-wide scenario or macro scenario, the second one being insurer-specific, third being a combination of the first 2, with the fourth scenario being parental support as limited, and with the 5th being closure to new business. Once again, the first 3 scenarios are not required of captive insurers, with the first 4 not required of third country insurers with Irish branches. So we're looking at severe scenarios that push the company to the brink of breaches and slotting in the recovery indicators and options identified and assessing them. These assessments should be based on the impact of own funds, liquidity, risk profile, SCR, and a judgment as to what option or series of options will be chosen under that scenario. Across all the scenarios, the company also needs to consider their overall recovery capacity. We have seen that companies can devote a lot of time to considering the scenarios that could drive them to breaches, but maybe don't spend as much time on the indicators required for monitoring and options to be ultimately implemented. So it is important to have a complete approach across these 3 areas. The final sections of the plan cover communication plans and information on preparatory measures. For the communication plans, they need to cover both internal and external communications. The communication plans also need to be tailored to the recovery option or options that have been chosen and need to manage any potential negative market reactions. For the information on preparatory measures section, this is providing info on the measures already taken to prepare the recovery options for implementation, and should address any impediments that have been flagged in the plan. Where preparatory measures are not yet in place, it should provide timelines for putting them in place. This is an area that we recommend consideration to. We have seen with clients that what first appears to be a relatively simple preparatory measure can flag unforeseen challenges. For example, the process of receiving a capital injection from a parent. Do authorised share capital amounts have to be increased? Do you have to file any documents with the company registrar office? Where will the money ultimately end up? What bank account? Knowing and preparing for these challenges will save a lot of time if this option ever has to materialise. So that was a brief walkthrough of the consultation paper. The closing date for the response to the consultation is the 30th of October. As you can see, there's quite a lot to consider, and the resources required to set up the plan would not be insignificant. And this has been flagged by industry. We have also heard comments around the fact that these regulations have been released before EIOPA have released their own regulations on recovery and resolution. So, for example, some companies who already have their plan in place will have an exercise to ensure their plan aligns to these regulations, but then may also have to do a further exercise to ensure they align with EIOPA's regulations, once again feeding into costs. Also flagged is the fact that the recovery plan is entity specific, so won't allow for a more general top-down group approach, or the fact other entities within the group may be on different rules for recovery plans, whilst the EIOPA are formulating their plans. And whilst proportionality is flagged with reduced requirements across capitals and third country branches, the requirements could still weigh heavily on smaller firms. The CBI has also explicitly called out this area for responses within their CP. I also note that Insurance Ireland are working on a draft response at the moment and welcome all inputs from their members. So finally, I will point you to the briefing note that we pulled together on the CP, which goes into further details on the regulations and guidelines. It can be found on our website under recovery and resolution plans or at the below link. And also, thanks for the opportunity to wear a shirt and tie for the first time in 6 months. I don't think my Adam's apple really appreciates it though. And with that, I will hand over control to Rick. Oh, apologies. We were having possible issues earlier on. There.
Yeah, it works. So thank you, Connor, for your very insightful presentation, and welcome everyone to this next session, which is on reinsurance as a capital management tool for life insurers. So the first half of this year, we spent quite some time investigating on how reinsurance can be used as a capital management tool, what the criteria are of implementing this efficiently and effectively, and focusing on trends and developments in the market. We did our own research for this and also interviewed several reinsurers, and this resulted in a research paper and executive summary, which you can both find through the link shown at the bottom of the slide. As Aisling mentioned before, I won't go into all details of this paper today, but we'll mainly focus on the main conclusions and observations, which are as follows. So first of all, capital management is an increasingly important and complex puzzle to solve. There are many targets and variables to consider when optimizing the balance sheet. Both your short-term and long-term impacts should be considered. And when choosing reinsurance as a tool to manage the capital, it's important to realize that the due diligence process is quite a lengthy process. And therefore, it's important to get the main targets clear at the start before involving any reinsurers or regulators. Secondly, we saw that several new type of covers and strategies are being used in the market. So next to the more traditional treaties, such as your quota share or excess of loss reinsurance, we also see an increase in popularity of, for instance, asset-intensive reinsurance, catastrophe bond type, or structured product types reinsurance covers. And finally, regulatory approval can be quite challenging and lengthy. An effective transfer of risk is required for this, and regulators seem to be wary of treaties that could be interpreted as a regulatory arbitrage. And secondly, getting your risk management systems up to date to manage and monitor your risk profile after implementing a reinsurance cover is quite important for this. So having made these three main conclusions, let me get into detail on them. So first of all, why capital management, and why is this capital management increasingly important and complex? Well, Life insurers face multiple risks that evolve over time and requires them to hold capital as a buffer against them. And this can be quite complex because of the long-term nature of an insurer's liabilities, causing their risks to evolve over time and really forcing an insurer to consider both the short-term and the long-term impacts on his balance sheet. But next to this, you should also consider low interest rates. So these cause increased capital pressure and reducing profit margins. We have capital pressure from stakeholders. So on one hand, we have the shareholder who probably wants to maximize the value of your company and dividend payments. While on the other hand, we have the regulator who potentially has a more conservative view on things. So using capital management, we have to manage the interests of all stakeholders. Increased regulations, think of the introduction of Solvency II and the 2020 review, but also IFRS 17. And finally, competition. So the increasing presence of private equity firms, consolidators, and insurtech firms further really pressures insurance companies to create value themselves. And within this environment of, let's say, competition, low interest rates, regulations, and opposing stakeholder interests, we need to optimize our risk management. We need to optimize our capital management, but ultimately, we need to optimize the capital amount, the Solvency II balance sheet, and the P&L, and with that, create value for our company. And one of the tools available for this is reinsurance. Now, reinsurance is quite an interesting option to consider because it has a wide variety of uses and ancillary benefits. Think, for instance, of you can unlock capital currently locked into capital-intensive portfolios, such as annuity or saving books. It can help you support writing new business by reducing the new business capital strain. When looking at the matching adjustment, it can also be of help with this. You can, for instance, reinsure options and guarantees on your liabilities, and by doing so, make them fixed so that they're actually eligible to be used in the matching adjustment. And finally, interest rate risk on the risk margin and coverage ratio can also be reduced using reinsurance. Now, of course, reinsurance is not the only capital management tool out there, and I want to stress that every management action comes with its trade-offs, and this certainly also holds for reinsurance. So it's by no means a magic tool, and it's therefore important to evaluate these trade-offs. And to do this, you would typically follow a decision process that looks a bit like the process you see at the bottom of the slide. So the first step is really to set your main targets. So what are my main goals that I want to achieve? And what are the corresponding key performance indicators and key risk indicators? Secondly, I need to consider the tools available to meet these targets. So which type of reinsurance treaty could be beneficial, or is reinsurance the best option at all? And finally, I need to consider the impacts on my balance sheet and P&L, both on the short term and the long term, because it can very well be that the reinsurance strategy might be very beneficial right now, but it becomes suboptimal on the longer run. Now, considering this process and looking at it at a bit more detail, you see that a lot of variables need to be considered when optimizing this. Now, in the research paper, we describe all of them. For this session, I won't do that, but some areas that I specifically want to point out here are as follows. So in the green box, you see the impact on capital requirements. So it's important to realize that when you implement a reinsurance treaty, you not only transfer risk to the reinsurer, but you also introduce potential new risks on your balance sheet. An obvious one is counterparty default risk, but another one is basis risk. And these risks can make your life a lot harder as an insurance company. When you, for instance, place collateral to mitigate counterparty default risk in the form of fixed income assets, it can very well be the case that the event of a default of the reinsurer and the event of a downgrade of your collateral are highly correlated. And in this case, your collateral might provide less protection than you initially anticipated on. So it's important to fully understand your new risk profile and include them in your risk management system by monitoring and managing them. Secondly, in the blue box, you'll see the cost of reinsurance. So not only do you have to pay a reinsurance premium, but the reinsurance cover might also introduce admin costs. Or maybe you need to upgrade your reporting system to deliver sufficient information to the reinsurer, And finally, implementation. So availability. Do I get enough quotes to choose from for this cover to be effective? Flexibility. What are the options in terms of termination, or what is the duration of the cover? And then, of course, there's regulatory approval, which we'll discuss at the end of this session. Now, considering this process and all these variables, one might say that the capital optimization process has many variables to consider and is therefore quite complex. Both the short-term and the long-term impacts should be considered, as they can vary quite significantly. And this complexity can result in a lengthy and complex due diligence phase. And because of this, it's important to get your main targets clear at the start and get agreement on this at all your layers of the company, as this will prevent discussions on whether you're actually looking at the right KPIs or KRIs halfway this lengthy due diligence process, and maybe wasting your time even when you conclude you're looking at the wrong things after all. So the first step really is to get agreement on what exactly to optimize and what to achieve. And only once this is done, you should include reinsurers and regulators in this process. Next to this, and I'm a bit conscious of time, so I'll skip the first part. Recall that we had 3 steps in this decision process I explained earlier on. So we set your targets, we evaluate a reinsurance cover, and finally we consider the short-term and long-term impacts on our balance sheet and P&L. But there's actually a 4th element in my decision process, and that's when to implement the cover. So it can very well be that the coverage ratio of my company is currently such that I don't really have the need to implement a capital management action. But it actually might be worthwhile to already consider a reinsurance cover, because what I can do, for instance, is implement a reinsurance cover with a minimal scope right now, let's say a 10% quota share treaty, go through the entire due diligence process, and in the future, when my company is actually in an adverse scenario, I can increase the scope, so going from 10% to a 90% cover, quite easy without going through the entire due diligence process anymore. So by doing so, this becomes quite an effective and quite a quick management action to implement. And such a preemptive reinsurance strategy is also called a just-in-time reinsurance, which is just one out of many. And this brings us to the next topic of today. And I should go one back, which is reinsurance treaties and strategies in the market. So in our research, we found that the range of reinsurance covers available is expanding. And this is nice because it enables the implementation of new reinsurance strategies as well. And we found that so-called traditional reinsurance covers are still widely used and popular in the market. But next to that, with the introduction of Solvency II and other frameworks, came new reinsurance cover really tailored to this. So tailored to the more Solvency II balance sheet items and tailored to capital management. Examples are mass lapse reinsurance. Another example is the contingent type of reinsurance cover that can be used, for instance, to stabilize your Solvency II earnings or mitigate interest risk on the risk margin. And all these covers and strategies you'll see in this overview are treated in detail in our paper, but for this session, we'll only focus on 2 of them, which are asset-intensive reinsurance and mass lapse reinsurance. Now, considering the mass lapse reinsurance, I think it's important to first realize how my capital requirement in Solvency II is actually determined for lapse risk. So the lapse SCR is the maximum of 3 individual capital requirements for lapse risk, namely mass lapse risk, lapse up risk, and lapse down risk. And the composition of your risk profile really determines whether it makes sense to reinsure lapse risk in the first place. So if you look at these 2 examples, then in example 1, it might not be the best idea to reinsure lapse risk, whereas in example 2, it actually might be quite an effective measure. And the reason for this is as follows. So reinsuring more than one type of lapse risk is going to be too expensive to be effective. So in example one, if you, for instance, would reinsure your mass lapse risk, your capital requirement of 100 would go down to 0, but your lapse up risk is still 90. So effectively, your overall SCR for lapse risk is only decreasing by 10. And this doesn't even take into account any counterparty default risk that might be introduced, basis risk, or maybe a decrease in diversification benefits. So the capital reduction of 10 might even be lower. Now, when we look at the market, we're only aware of mass lapse treaties being implemented. So no lapse up or no lapse down treaties. And we think there are two main reasons for this. So first of all, the probability of a company overestimating or underestimating their best estimate persistency rates, which is the lapse up risk and the lapse down risk. So that probability might be a lot higher than the 40% mass lapse shock occurring. And this makes reinsuring lapse up and lapse down risk potentially a lot more expensive. Secondly, from a reinsurer's point of view, you might be hesitant to actually reinsure a risk such as lapse risk. Expense risk is another of these examples, because it can be quite difficult to estimate what the actual risk is you take on your balance sheet. And it's also quite difficult to actively manage this risk at the ceding company. Looking into a bit more detail in these mass lapse covers, it's firstly important to realize that in Solvency II and also for regulators, it's very important that a reinsurance cover has to lead to an effective transfer of risk. And this requirement for an effective transfer of risk is really to prevent regulatory arbitrage. So in case of a mass lapse risk cover, only reinsuring the very specific 40% Solvency II stress, so not the 39.9 or 40.1 stress, would be considered as regulatory arbitrage, because the probability of this exact stress happening is very low. And therefore the premium for this cover would also be very low whilst getting full capital benefits. So in practice, mass lapse covers are structured as a kind of catastrophe bond, where the reinsurer starts paying out when the mass lapse stress is in between a predefined attachment point and a detachment point. And by doing so, you make sure that a sufficient amount of risk is actually in scope of the cover and therefore transferred by the cover. Nevertheless, we see that lapse reinsurance deals are coming under increased scrutiny by regulators because they're really challenging the effectiveness of the risk transfer of these covers. They're actually just, I think, considering these as regulatory arbitrage. And therefore, in some jurisdictions, regulators have not allowed the use of these mass lapse reinsurance covers anymore to mitigate the SCR capital requirements for lapse risk. One final point to mention here, that's basis risk. So determining a mass lapse event requires quite some expert judgment. And with this amount of expert judgment, there's also the chance that you might have basis risk in the cover. So next to having an effective transfer of risk, this basis risk is, I think, a second important point to realize or to consider when looking at these type of treaties. The second example of today, asset-intensive reinsurance. So a lot of reinsurance covers and strategies are specifically designed to cover one or more individual risks. However, solutions also exist that can be deemed more all-encompassing. And one of these is asset-intensive or full risk reinsurance. So it covers all risks in scope of the block of business, except for maybe expense risk and maybe lapse risk. So this asset-intensive reinsurance is almost a kind of co-insurance. And this type of reinsurance is usually applied on large in-force blocks, legacy books of business, with long-dated liabilities, a lot of guarantees, heavily weighted on asset and interest rate risk, such as savings and annuity business. And implementing such a cover has several advantages. So first, it's a relatively easy way to unlock large amounts of capital currently locked into your books of business. The extensive scope of risks and the size of business included can lead to lower premiums charged. And finally, next to transferring risk, it can also be an alternative to portfolio transfers. And it can be used to lock in the value of your business during the period between closing a deal and getting regulatory approval during an M&A process. Of course, there are also some disadvantages to this. So the sheer size of business and risks involved can really lead to substantial amounts of counterparty default risk, potentially even leading to the requirement of capital add-ons in Solvency II. Related to this, the Solvency II standard formula might not be able to appropriately capture this newly introduced counterparty default risk anymore. And finally, because this is a relatively new type of reinsurance, also for regulators, the due diligence phase can be quite challenging, and getting your collateral management right and in place is a very important part of this. Now, to conclude this second topic, so our research showed that the traditional treaties and strategies are still widely being used. New solutions are also introduced in the markets with a shift towards asset-intensive reinsurance and structure type and catastrophe bond type of covers. And with these new strategies and an increased focus on reinsurance of insurers, also come new challenges. You need to mitigate your basis risk. When looking at a cover, you need to assure an appropriate risk transfer. Collateral management is important. And finally, assuring that your risk management systems are up to date to sufficiently and continuously monitor and manage your new risk profile. And also new risks such as basis risk and counterparty default risk and collateral. Having risk management systems in place for that is also very important. Now, most of these areas here are also in scope when getting a regulatory approval, which brings us to the next subject and the final subject of this presentation, which is regulatory approval. So there are several criteria the regulator will look at for accepting reinsurance transactions, and most of these we already discussed throughout the session. But for instance, you need to have a clear business rationale for implementing the treaty. You need to have a strong understanding of the risks that are being transferred, that remain on your balance sheet, and new risks that emerge. A clear analysis and consideration of different possible outcomes, including scenarios where the reinsurance may not be effective anymore, is important. The counterparty, collateral arrangement, and the reinsurer's jurisdiction might be important during this regulatory approval phase. And finally, you need to have recapture plans in place, such in case the reinsurer is in financial distress or even defaults. But at the end, I think demonstrating that the reinsurance deal is genuinely used as a risk mitigating technique is key for getting regulatory approval. And we already saw this earlier on with the Mass Lapse Treaty being regarded as regulatory arbitrage. And another example is the index-linked longevity swap. So in the Netherlands, many insurers used to purchase very far out of the money longevity swaps to hedge their longevity risk and lower capital requirements. And the reason for this is because it was out of the money, the premium would be very low and the capital gain they got was still quite high. The Dutch regulator doesn't allow for this anymore and argues that the premium paid for a cover should be an indication for the actual risk transferred. So the premium paid and the risk that's transferred should be balanced. Next to this, there are a few other things I'd like to point out on regulatory approval. So for material and complex reinsurance, the CBI requires companies to carry out an in-depth review of how the Solvency II requirements are met. As mentioned earlier on, you need to have a sufficient risk management system in place, and this doesn't only cover the new risks or your new risk profile, but also your appropriateness of the reinsurance selected. And other particular points of focus by the regulators are as follows. Concentration risk, which is especially important when the risk exposure to a reinsurer has a loss potential which is large enough to threaten your solvency position. Retrocession, So when using retrocession to manage reinsurer risks, insurers must monitor this in case the retrocessions have a significant impact on the effectiveness of your reinsurance contract. And in fact, if this retrocession introduces basis risk or other risks that are not reflected in the Solvency II standard formula calculations, this reinsurance contract does not actually qualify as a risk mitigating technique. And finally, the risk margin. So the counterpart to default risk module in the standard formula excludes the risk margin from the calculations. And the Dutch regulator has indicated last year that if the risk margin increases substantially in case of a default of the reinsurer, then you should take this impact into account in the CDR calculations. Now, to wrap this final topic up, regulatory approval can be challenging and lengthy. It's important to demonstrate that the cover is genuinely used as a risk mitigating technique. This also holds for having appropriate risk management systems in place. And finally, collateral management can play an important part in this process, especially if the scope of your cover is quite wide. I like to conclude with this. Early engagement with regulators is often the best way to achieve a positive outcome when trying to implement a new reinsurance arrangement. And with that conclusion, I'll hand my slides over to Kevin.
Thanks, Rick. While I'm waiting for control to come through. Oh, I have control. This is great. A sense of power. This is a tough act to follow. Rick was recently, people are connected. He was recently nominated for an award as one of the top 3 under 35 actuaries from the Netherlands. And meanwhile, I'm pretty sure Connor is one of the top 3 young actuaries from RD. So it's pretty tough gig for me to have to follow the 2 of them. Sort of been through a presentation. You've just finished a presentation on kind of capital management, reinsurance as a capital management tool. I started a presentation on recovery planning, and you're wondering what next to watch. I'm pretty sure Netflix would come up with a recommendation for you. And I think you'd find that this presentation on unit matching under Solvency II would be a pretty good match. Like reinsurance, I guess, unit matching is a very powerful tool from a capital management perspective. It also has the capability of helping restore solvency coverage, and it can help to restore liquidity too. So it can be quite a useful lever for a unit-linked company looking at its recovery planning as well. So I think it will be a pretty good match. Not a perfect match. Unit matching isn't for everybody, I guess, and not even for every unit-linked company. So I'm only giving it a 96% match. 100% match is kind of having less than 100% match is kind of the point of unit matching in some respects. That's a pretty nerdy joke, which I will explain a little more over the next couple of slides. I guess this isn't my first time in front of an audience talking about unit matching, and in the past, I guess unit matching has. Some of the presentations on unit matching have kind of been from a theoretical perspective. I want to spend a bit of time today focusing a little more on the practical considerations, but I thought in case you missed sort of season 1 and season 2, it might be worth doing a quick recap of the theory of unit matching. So this graph looks a little complicated, but really in simple terms, I guess for a unit linked insurer, you have a unit linked surrender value, which is the kind of navy box marked A here. And the kind of motherhood and apple pie approach to unit linked risk management is to hold unit linked assets that equal that. So that's the kind of attractive brown colored bar over on the right hand side marked B. And the theory then is, well, if unit prices go up or down, the liability in A goes up or down, and your assets in B go up or down by the same amount, and the net impact on you is 0, which is all wonderful from a risk management perspective. I guess one of the challenges on a Solvency II balance sheet is that you also have some other bits of the balance sheet that move when unit prices move. And in particular, there's that kind of peachy colored box marked C, which is effectively a negative liability or an asset, I suppose, the present value of future annual management charges. That sort of flows through directly to your Solvency II balance sheet, and obviously as unit prices go up or down, that negative liability can fluctuate too, which brings effectively a direct hit to your Solvency II balance sheet from movements in unit prices. There can also be an impact on risk margin, where for a lot of unit-linked insurers, risk margin is driven primarily by lapse risk, and the lapse risk component of the SCR will typically go up or down with unit prices too. So you end up on the Solvency II balance sheet, I guess, if you're following this traditional matching approach, that there'll be quite some fluctuation that can arise from changes in unit prices, and that fluctuation, which is a source of market risk, I guess, will then flow through into the market risk component of your solvency capital requirement. So I guess an alternative approach to this is to hold a lower amount of unit-linked assets, and this is kind of the underlying principle of unit matching. If you held unit-linked assets at the level, the lower level shown in box B here, you'd effectively be matching the bits of your balance sheet that move in line with units. In this simple example, assuming that the full risk margin moves in line with units, you could then hold some other assets to match the non-linked parts of your technical provisions, which might be things like future expenses, and you'd have some surplus assets, and you could invest those whatever way you thought was most appropriate. And this gives you a much better, much more protected position from a market risk perspective, and lines up with the Solvency II requirements, I guess, which talk about matching unit-linked benefits, holding unit-linked assets that cover the technical provisions in respect of those benefits. So that's kind of the theory for unit matching. I guess there are pros and cons, and the sort of the case for unit matching, I guess, sort of focuses on that reduction in market risk, the follow-on implications for SCR, the potential liquidity benefits that can arise, and even some lapse risk management benefits, particularly where you have a correlation between increased lapses when markets are down. Unit matching approach can mitigate that to some extent. There's quite a few arguments against unit matching. I think the primary one, which I'm sort of calling the monster under the bed, is this sort of notion that, well, what happens if the markets race ahead, we're not as fully in the markets as our policyholders are, and then what happens if everybody decides to exit or lapse their policies? Surely there's a big financial risk there. I feel that this risk is probably somewhat overstated, or at least it's sort of blown up in the minds of people. And I guess if you get your granddad on the Skype to look under the bed for you, you'll get a sense that there probably isn't a monster under there. But it's certainly one that needs to be considered. The interaction between lapse up risk and market risk, I guess, is something that's a little different for a company employing a unit matching strategy. So that's something you'll need to take into account. I guess broadly speaking, while on the previous graph I showed that sort of line for the technical provisions in respect of linked benefits, that's not a target for unit matching. That's a floor effectively, and for any company employing unit matching, they're going to operate at a level somewhere between the sort of fully matched approach in the old world and this sort of fully undermatched approach in the new world. And when you operate at that level in between, what you're effectively doing is, unit prices racing ahead will be good news for the company, but just dampened somewhat by your approach to unit matching. Similarly, if there's falls in unit prices, that'll be bad news for the company, but the bad news will be mitigated by your approach to unit matching. So I guess that's enough of the theory. I did want to talk a little bit about the sort of the practical challenges that can arise, and maybe some of the practical experience that we're seeing, particularly from the UK. So I guess in that context, it's worth pointing out, we're aware of one Irish insurer who has implemented a unit matching strategy, so not sort of holding the full face value of or surrender value of units, which is primarily in the context of a hedging approach for unit-linked guarantees, so kind of slightly different to, for want of a better word, a vanilla unit matching approach. There are a couple of other Irish insurers that we know of who have looked at unit matching in some detail, and I'm aware of one company that's quite advanced in its plans in unit matching and in terms of its engagement with the regulator on that. By contrast, I guess in the UK, there are lots of insurers, or at least a number of insurers, who have implemented unit matching. A few of those have made public announcements on it in SFCRs and in other places. So Scottish Widows, Scottish Equitable, and Reassure have all made public announcements on it. I'm aware that I've been at presentations from people from Aviva have talked about their unit matching approach at industry events too, and we're aware of 2 or 3 others who have implemented unit matching but haven't spoken so publicly about it. I wanted to pull out a sort of 4 particular areas just to comment briefly on around the practical challenges, policyholder impacts, the regulatory response, and then implications for systems. There are lots of other things worth considering, and worth pointing you to a paper written by colleagues in our London office that takes a closer look at unit matching and the UK experience, and will provide I think some really interesting insights into some of those challenges, as well as looking at alternatives to unit matching and other approaches to manage the market risk that can come from unit-linked business. So let me start with some of the practical challenges. I'm keeping with my next Netflix theme by sort of having a movie for each of these, and I struggled with a movie that represents practical challenges. So I've got Practical Magic. You need a bit of practical magic to address some of these. Some of them are pretty straightforward. Not every fund that you have and not every product that you have will be suitable for unit matching. So you're going to need to spend a little bit of time just analysing your funds, looking at the stability of the lapse experience. It might be around whether funds are open or closed to new business, and the level of flows that are going into the funds, and the level of AMCs or unit-linked margins on the funds can be a factor too. You will need to look at your best estimate liability and understand which elements of the cash flow are linked to unit values and which are non-linked. That's mostly pretty straightforward, but there can be some bits at the edges, particularly where you have death benefits on products, or potentially if you have regular premiums that fall inside the contract boundary, that can create its own issues too. So there's a few things to think about there. Maybe a more material challenge is around hypothecating your unit-linked cash flows back to a fund level, or your unit-linked BEL back to a fund level. I think for most companies, you'll run your cash flow projections at policy level or model point level. You'll have assumptions and you'll aggregate results at product level often. You won't typically look at fund level to the same extent, whereas your unit matching activity will be at fund level. So you'll need some way to effectively translate those product level or policy level cash flows and results back to fund level. And that could introduce challenges reflecting differences in lapse experience or differences in margins between products. So there's a little bit to think about there. I mentioned risk margin earlier as being largely unit linked for lots of companies. So how you treat risk margin in your unit matching approach is an interesting one. In the UK, we've seen different approaches. Some insurers include the full risk margin as unit linked, and maybe that's a slightly prudent approach. Some try and split risk margin between unit linked and non-linked elements, and some leave it out altogether, typically on the basis that there's some prudence elsewhere that kind of covers that off, and it sort of all comes out in the wash. But it's something that I think each company will have to just give some consideration to. And all of those factors, I guess, build up to maybe a question around what's an appropriate buffer. I mentioned earlier the technical provisions for unit-linked benefits is maybe a floor rather than a target, and you will need some headroom above that to give yourself a buffer. And in part, some of these questions around how you hypothecate the fund level, how you treat the risk margin, and so on, can influence that buffer, as well as the stability of your lapse experience and your own risk appetite. So those are all things that you'll need to consider. I guess it's important not to forget policyholders in this. My attempt at a movie to represent policyholders is the client, and I guess, you know, thinking about the client is important in this context. So maybe one of the first questions that people ask in the context of unit matching is, you know, will it have a direct financial impact on policyholders? You know, surely if you were 100% in the managed fund and now you're saying you're going to be 97% in managed fund and 3% in cash, does that not dilute returns for policyholders? So important to just make it clear that unit matching decisions are investment decisions at the company level. It's how the company, the shareholder, is investing its assets. So it's effectively like a negative box, I guess. From a policyholder perspective, they'll still be 100% exposed to the managed fund or whatever fund they've chosen, and there will be no direct financial impact from unit matching. There could be second order impacts, though, that you'd need to think about. I think there will be, the company will have some trading that will go on from its own unit matching approach, whatever rebalancing it may need to do over time. Those trades can have an impact potentially on the unit funds and could have a second order impact on policyholders. I think for the most part, the UK experience sort of sees a lot of those trades maybe falling into the normal discretion that a company would have around its box management. But in particular, I guess the larger trades, especially say if you're introducing a unit matching approach and you have a big trade at the start to sort of get yourself up and running, you need to be careful that those larger trades don't impact in terms of pricing basis or impact in terms of asset splits within the funds as the investment manager then goes and processes the cash flows. And obviously there's a potential beneficial second order impact if the company can manage its capital and its risk better. It should ultimately lead to a more financially secure company. And we're just mentioning T's and C's, marketing literature. What have you told companies about how you'll run your unit funds? And is there anything in there that would limit or prohibit your ability to run a unit matching strategy is something that you'll need to give some consideration to. So if you had 5 minutes or 10 minutes on a Sunday afternoon and you were trying to find a movie to represent the regulator, what would you come up with? With apologies to anybody from the CBI in the audience, I've gone for the regulators. Or people do sort of say, yeah, unit matching sounds all very well and never get it past the regulator. Is a couple of slides left.
Apologies, I think we lost Kevin there just at the end, conveniently when his face was over Clint Eastwood's there, so that was a nice coincidence for him. So thank you all very much for attending. I don't think Kevin had too much left to cover, although it is unfortunately the most interesting part of most of these topics, I think, is what does the regulator think? But some very interesting and practical information there on all three of our topics: recovery and resolution planning, reinsurance strategies, and unit matching. As I said at the start, we will be sending a survey tomorrow morning, and we will be encouraging you to complete this by offering some spot prizes. The event is CPD verifiable, so Teams does keep a record of everyone who has logged in. So we have a record of that for you, and it's verifiable for CPD. And finally then, if you have any questions, please do send them in. We have 2 minutes, and we have one published question for Connor on recovery and resolution planning. And Connor, the question there was what advice we'd have on overlap with the ORSA process.
Okay, thanks, Aisling. So I'd say the CBI does call out in the CP that expects interlinkage between the recovery plan and the ORSA, and includes a small section on this as well. I do believe it has provided a rather narrow view of the ORSA in saying its aim is to ensure companies doesn't breach its SCR, when in practice it does cover much more, for example, around liquidity considerations. The CP does mention that capital recovery indicators should be aligned with the targets or thresholds specified in the ORSA, so a strong link or overlap there. I do think a strong link or overlap will be seen in the scenarios considered for the recovery options as well. So the talk of system-wide and insurer-specific scenarios and combinations very much flag ORSA scenario consideration for me. I would caveat that also, though, with the fact that companies shouldn't limit themselves to considering only a range of their ORSA scenarios in the recovery plan. the CP does highlight a bit of blue sky thinking around recovery options, and this would carry through to the scenarios also.
Thank you, Connor, for that. I have found also in my experience that if you have done a good ORSA process, then you're certainly in a very good position to kick off your recovery and resolution planning. But there is certainly a lot more to it than you might have covered as part of the ORSA. We do have a couple of more questions coming in there, and I think Kevin has rejoined us. So I might, oh no, we've lost him again. So we've one more question on reinsurance treaties and if non-proportional treaties are more effective than proportional for capital optimization. So very quickly, Rick, are you happy to take that? Rick, you're on mute, just to get that cliche in before we finish up.
Very good. And my children are playing in the background. Well, I suppose very good question. I don't have an immediate answer to it because I do think it really depends on your risk profile and how you structure that the reinsurance cover itself. So yeah, if you want to discuss it in more detail, maybe you can have the discussion later on after this session.
Thank you. Okay, I guess that was submitted anonymously, so if whoever what that was wants to get in touch, we can cover that off separately. So I do want to get you all out on time. It is a sunny day in Dublin anyway, so I hope you all get to go out and enjoy your lunch break. Thank you for joining. Please do complete the survey and we'll be in touch again soon. We hope to have another briefing in October, so we'll be in touch with you in relation to that. Thank you all. Goodbye.